Welcome back to Alpha Recap. Short and sweet intro today. Markets closed after a pretty eventful session, and we've got a lot to unpack. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. We saw two big themes play out after the close. A renewed risk-on tilt that helped tech and AI names, and some sharp company-specific moves that really reset expectations for individual stocks.
Okay, set the scoreboard for us. What were the big headline moves?
Broad strokes. The 10-year U.S. Treasury yield moved down about 2 basis points to roughly 4.47%, which eased discount rate pressure for long-duration names. Nasdaq futures closed up about 0.6%, driven by AI leadership and some follow-through in growth flows.
And at the stock level, it was dramatic, to say the least.
Huge dispersion. One-day swings were massive. For example, Zscaler plunged about 31% after management offered what they called prudent guidance and rearranged sales leadership. By contrast, Abercrombie & Fitch rallied roughly 12% after an earnings beat, even though EMEA sales were down about 10%. FedEx jumped about 2.9% after a big bank upgrade emphasizing a potential freight spinoff in the upcoming fiscal fourth quarter report on June 23rd. Plus, there were governance headlines. Lululemon agreed to add 2 board nominees, settling a proxy fight, and Elemental Impact launched a data center initiative with Amazon, Google, Meta, and Microsoft.
Wow. So what really stands out here is the contrast between broad market momentum and these concentrated shocks.
Exactly. The tape showed leadership bifurcation, concentrated winners and concentrated losers. Indexes can grind higher while breadth narrows because a handful of big names carry the weight, especially AI-related names right now.
Hold on. Say that again? Why does a single name like Zscaler move the way it did? That felt extreme.
It is extreme, and it's symptomatic of how sensitive the market is to guidance in subscription businesses. For software-as-a-service companies, guidance is a forward signal for annual recurring revenue, ARR, and renewal dynamics. If management signals conservatism, multiples compress quickly because the valuation is built on future growth visibility. Zscaler had already lost about half its value over the past year, so sentiment was fragile. Combine cautious guidance with a sales leadership shakeup, and you get a punctuated sell-off.
Not a great day for some SaaS names.
No, and that's the point. In this market, company-level execution and the exact wording of guidance matter more than in a low-rate environment. Traders reacted quickly and violently.
Okay, pivoting. Elemental Impact and the Hyperscaler Group. That seemed like a stealthy but important development. Explain.
Sure. This data center innovation initiative is convened by a nonprofit but backed by the big hyperscalers. It's not a direct revenue play for the cloud giants, but it's a coordination mechanism that could speed up adoption of energy efficiency tech across massive data center footprints. For vendors, think cooling, power management, efficiency chips, and analytics. Standardization and faster pilots can expand addressable markets and shorten commercialization cycles. It's a slow burn, but potentially durable.
So suppliers could see demand accelerate if the hyperscalers standardize metrics and buy-in ramps.
Exactly. It's about scale and repeatability. If these big players agree on metrics and tests, smaller suppliers can move from pilots to broad rollouts faster.
Let's dig into FedEx for a second. Spinoff chatter has been around for a while.
JP Morgan's upgrade highlighted a freight spinoff as a potential value unlock. Spinoffs can reprice conglomerates because they separate businesses with different margin profiles and capital needs. The near-term catalyst is the fiscal fourth quarter report on June 23rd. That earnings release will either validate the thesis or create short-term volatility.
Right. And the other thing is execution risk on spinoffs can be real.
Absolutely. A successful spinoff requires clean carve-outs, clear guidance on capital allocation, and favorable market reception. If any of those elements falter, the value unlocking narrative can stall.
Switching back to retail, Abercrombie popped despite geopolitical headwinds in EMEA. What gives?
They beat on earnings, and that matters in a sentiment-driven tape. But the roughly 10% EMEA sales decline tied to the Iran conflict shows how geopolitics can skew regional results. The market rewarded the beat, but the real question is whether the surprise converts into durable top-line recovery rather than a one-off margin or timing effect.
Yeah, that tracks.
And don't forget the governance angle. Lululemon settling its proxy fight removed an overhang, which analysts see as reducing uncertainty. That can matter as much as an earnings print for a name that had activist attention.
Short reaction? Wow, 31%. Okay, let's zoom out. What were the recurring themes you saw across today's coverage?
4 big themes. 1. Leadership bifurcation. AI and tech were leading, but internals were narrow. 2. Event-driven catalysts dominated stock moves, like earnings, guidance, spin-off talk, and governance outcomes. 3. Macro cross-currents. Yields moved modestly lower, which helped long-duration assets, but geopolitical risk kept a lid on unreserved optimism. 4. Governance and corporate structure actions removed idiosyncratic overhangs and can catalyze re-ratings if execution follows.
There was mention in the coverage of a debate about whether earnings growth signals a late-cycle peak versus validating the rally. Walk me through that.
This is the classic valuation versus momentum debate. Some commentators point out that when you see double-digit S&P earnings growth, historically it sometimes coincides with late-cycle peaks. Others, momentum players, interpret accelerating profits as fuel for the rally. So one camp worries about valuation stretch, the other sees execution and revenue acceleration as confirmation. Both views have merit, and the market is effectively adjudicating that tension in real time.
Honestly, I was a bit surprised by the strength in AI names given the geopolitical noise.
Yeah, momentum can be powerful. Lower yields gave a bit more room for growth names, but the market's appetite for risk remains conditional. A fresh headline on geopolitics could reverse the mood quickly.
Short reaction? Yeah, that tracks.
For investors, the implications differ by type. Traders and event-driven funds should focus on upcoming dates. Think June 23rd for FedEx and earnings cadence for other big names, because single-name volatility creates short-duration opportunities. Growth and AI investors should watch guidance tone and ARR dynamics closely. Income and value investors might find a yield environment that still supports income strategies, and spin-offs or governance resolutions can create opportunities, but patience and fundamental work are required. Macro-focused investors should prioritize portfolio resilience given headline risk.
Good checklist. Give us 3 practical things listeners should watch this week.
1. Monitor guidance tone. In this market, the exact words companies use about conservatism versus optimism can move stock prices a lot. 2. Track corporate calendar catalysts, especially the June 23rd FedEx print and the next set of AI-related earnings. 3. Watch hyperscaler coordination projects like the Elemental Impact Initiative for slow but meaningful changes that can expand total addressable markets for suppliers.
Quick realism check. How should listeners interpret a single-day 31% drop or a 12% rally?
Treat them as sentiment compression or expansion signals. They tell you about market conviction at a point in time, but persistence matters. Follow through in earnings, guidance, and operational metrics decides whether the move is durable. Single-day moves are meaningful, but context and subsequent data are everything.
Got it. Any final takeaways before we close?
Markets closed up on a risk-on tilt led by tech, but the day also showed how idiosyncratic shocks can puncture valuations. Momentum remains potent for AI and growth, yet execution, guidance, and governance are all backstage drivers. The practical play is differentiated positioning. Be agile around event windows, pay close attention to ARR and margin signals, and don't underestimate governance developments.
Great summary. Quick reminder, this is for informational purposes only. We are not giving personalized investment advice or recommending buying, selling, or holding any specific security. Analysts note market moves and data to inform your own due diligence.
Right. If you take nothing else away, momentum is alive, but valuation and execution matter more now than in a low-rate regime. Keep an eye on guidance language, the corporate calendar, and headline risk.
All right, that wraps it up for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you next time.